Stop me if this sounds familiar. You know your estate plan needs updating, you've been meaning to look at that expensive fund sitting in your brokerage account, your financial data lives across 4 different platforms and nobody has a clean picture of the whole thing. You've known about this all for a while, you just haven't fixed it yet. That's what today is about, because the problem for most wealthy families isn't awareness, it's that nobody ever makes things feel urgent enough to act on. So let's change that. I want to be very clear about what this video is and isn't. This isn't a video about complex tax strategies or cutting-edge estate planning structures. I've covered a lot of that on this channel and I'll keep covering it. This is about the basic things that get overlooked, things that are quietly creating drag on your wealth every single year while you're focused on bigger decisions. When I say drag, I mean the literal sense. Friction that slows down compounding over time. Not dramatic losses, they're slow leaks. And slow leaks are the ones that are the hardest to notice and easiest to ignore. Let's go through them. Number 1, cash management. Most people evaluate their cash and short-term holdings by looking at the headline yield. And that's the wrong number. What actually matters is what you keep after federal and state taxes. And at a high income level, the difference between doing this well and doing it lazily can be surprisingly large. Here's the framework. If you're in a high tax state like California or New York, your combined marginal rate on ordinary income can be north of 50% when you're at federal, state, and city. That means a money market fund yielding 4.5% is actually putting 2.1 or 2.2% in your pocket. Treasury bills held directly also yield around 4.5%. But because they're exempt from state and local tax, your after-tax yield is closer to 2.7%. That gap of about 0.5% can really add up on a multi-million-dollar cash position. And it gets more nuanced from there. Depending on your state, your time horizon, and the current rate environment, municipal money market funds or short-term munis may actually produce the highest after-tax yield of all. And the answer isn't always the same, and it changes as rates move. The point is that optimizing your cash position isn't about chasing yield. It's about running the after-tax math specific to your situation and making sure someone is actually doing the calculation rather than just defaulting to whatever the brokerage is offering. Most families have never seen that clearly laid out, and if you haven't, you should ask for it. Number 2, that old mutual fund is still in your portfolio. I see this constantly. Expensive, actively managed mutual funds sitting in portfolios, sometimes with 1% or higher expense ratios, when almost identical ETF strategy exists at a fraction of the cost and with dramatically better tax treatment. ETFs don't distribute capital gains the way mutual funds do. Over a decade, that difference alone can be significant. The reason these funds stick around is usually one of 2 things. Either there's an embedded capital gain that makes selling feel painful, or there's simply no one pushing to make the change. Sometimes a thoughtful tax analysis will show you that the after-tax cost of staying in the fund exceeds the cost of ripping the bandage off and switching. That analysis is worth doing, and most families haven't done it. Number 3, you've never calculated the true cost of that alternative investment. Over the past decade, private wealth has become one of the most attractive sources of capital for alternative investment firms. Hedge funds, private equity, private credit, all of it has been packaged and made accessible to high net worth investors through advisor platforms and feeder vehicles. The access is real. The question is, what are you paying for it? Most families who hold alternatives through an advisor platform have never sat down and added up the layers of fees. You have the fund fees, 1.5% or 2% in 20. Then there's the access vehicle fees on top of that, then an advisor fee on top of that. When you stack all 3 of those fees, you could easily be giving up 3 to 4 percentage points of return per year. That is a number that significantly changes the math on whether the investment makes sense in the first place. Before you make your next alternatives commitment, do the total fee calculation, not just the headline number. Number 4, you're writing checks to charity instead of giving stock. This one is simple and the fix is easy, which is why I'm always a little surprised by how often it gets missed. If you have a taxable brokerage account with appreciated securities and you're also writing checks to charity, you're leaving money on the table. When you donate appreciated stock directly to a charity or a donor advised fund, you avoid paying capital gains tax on the appreciation, and you still get the full fair market value as a deduction. When you write a check, you get the deduction, but you already paid tax on the income that funded it. For families with large, low basis portfolios, this is not a rounding error. The tax savings on a $100,000 gift funded with appreciated stock versus cash can easily be $20,000 or more, depending on your situation. If you're not doing this already, call your advisor ASAP. Number 5, you assume your bank has the best mortgage rate. Your primary bank almost certainly does not have the best mortgage rates available to you. I've seen this play out repeatedly. Families with significant assets assume their relationship earns them favorable pricing. Sometimes it does, but the only way to know is to shop around, and most people don't. Running a competitive mortgage process where you get quotes from multiple lenders and let them know you're doing so almost always produces a better outcome. In some cases, significantly better. Your primary bank may ultimately match the best rate once you know they're competing for it. You need that competitive tension in the room to get there. On a $3 million mortgage, a 25 basis point improvement saves you tens of thousands of dollars over the life of the loan. That's worth an afternoon of phone calls. Number 6, your estate plan exists on paper, but not in reality. This is probably the one I see most consistently and has the highest potential cost. Families invest real time and money working with attorneys to build out a trust structure, and then the implementation falls apart. Assets never get retitled into the trust. Beneficiary designations on retirement accounts and life insurance policies are never updated and don't match the estate plan. Accounts that should pass directly to heirs end up going through probate because the paperwork was never done. It's worse than no estate plan at all because it creates a false sense of security. The fix requires someone who's actually tracking the details across every account, every entity, and every policy. It's not glamorous work, but it's critically important, and it's consistently where sophisticated families drop the ball. Number 7, your retirement accounts are just sitting there. High net worth families tend to underestimate what retirement and tax advantage accounts can do for them at their wealth level. These accounts are often on autopilot, invested in something generic and never revisited. There are real opportunities here that go beyond just maxing out your 401k. If you own alternative assets or expect high return private investments, holding them inside a self-directed IRA or retirement account can dramatically change the after-tax math. Roth conversion opportunities, particularly in lower income years, like a business transition or an early retirement period, are often missed entirely. The window for a large Roth conversion is often narrow and worth planning around deliberately rather than discovering after the fact that you missed it. Number 8, nobody has a clean picture of the whole thing. I want to end on something that ties all of these together, because there's a reason these problems persist even in financially sophisticated families. Nobody has a complete, accurate, real-time view of the whole financial picture. Investment accounts live in one place, tax returns in another, estate documents somewhere else. Alternative fund statements arrive quarterly via email from different administrators. Real estate ownership sits in LLCs that may or may not be on someone's balance sheet. And underneath all of it, most families are relying on a spreadsheet that someone updates manually once in a while and trusts approximately 80%. When your data is fragmented, these problems hide in the gaps. The old mutual fund doesn't get noticed because no one's running a comprehensive fee audit. Beneficiary designations don't get updated because no one maintains a master checklist tied to the estate plan. Roth conversion opportunities pass because no one projected this year's income picture until it was too late. Solving the individual items on this list is straightforward. The harder, more important problem is building a system where they get noticed and addressed consistently rather than accumulating quietly in the background. If you made it through this list and find yourself thinking, we should look at that, I'd encourage you to actually block time to do it. Not with a vague intention, but with a specific conversation scheduled with your advisor or your CPA. Pick the 2 or 3 items from this list that feel most relevant to your situation and make them an agenda item. The families who protect and grow wealth across generations are not necessarily the ones making the best investment calls. They're the ones who pay attention to the full picture, who have someone accountable for the details, and who treat the maintenance of their financial life as seriously as they treat the decisions. None of this is complicated. It just requires someone to actually own it. If you enjoyed this video, I'd appreciate you subscribing to support the channel.